Bitcoin 14-day RSI as oversold as it's ever been. And basically, after this, it can fuck around a bit and then slingshots out. So expect, you can't digest a move like this instantly, but we're talking, days, a week, 2 weeks maybe, before then the market takes off. Everybody is in extreme fear. You think the cycle's over, and all it's been doing is doing the same old shit. And it always does this. So these are all the corrections we've had since the start. We had a 20%, a 20%, a 20%, a 21%, a 33%, 31%, a 28%. And then we look at it back in the previous cycle. 31%, 9%, 21%, 14%. And the previous one to that was all 35, 40%. Then 50%. And it's like, guys, this is what you pay in volatility for the returns that you get. Look at the returns.
The financial markets are currently exhibiting a fascinating divergence between sentiment and data. While the fear and greed index has plummeted to panic levels, comparable to the lows of 2022, the forward-looking macro indicators are signaling a robust recovery. The core thesis currently revolves around the inevitable return of global liquidity. Historical data suggests that total liquidity lags specific monetary shifts by approximately 3 months. We are approaching a convergence point where the Treasury General Account drains, quantitative tightening concludes, and international balance sheets, particularly from China, begin to expand. This is not about hope, it is about the mechanics of the business cycle. The ISM data, which tracks economic health, is poised to pivot higher following these liquidity injections. Historically, when the business cycle expands, capital flows aggressively into risk assets, regardless of short-term noise.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Total liquidity lags it. So by 3 months. So it's suggesting that liquidity should start rising, which makes sense because we know what we've got to do. We've got to pay the debt, and we know that the TGA is going to be drained, and the QT is going to finish, and the Chinese are increasing their balance sheet, and we got regulatory changes coming, and we got rate cuts coming, blah, 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 blah. And the ISM, the business cycle, follows that. So the next thing for the business cycle is to go higher. Business cycle going higher means we'll have money in our pockets. It goes into risk assets, and that increases the price of crypto. It's not that complicated, but nobody wants to believe it because you're looking at 5-minute charts and scratching your nuts, wondering what's going on. You can't do stuff like that. It doesn't work. And demanding that you get paid. You can make all the demands you want. The market doesn't give a shit. And once you learn that, it's much easier to deal with. So at the ISM, we're seeing that it's some of the surveys are starting to increase sharply as the tariff stuff happens and people start getting more comfortable. What we've seen is like Empire survey started going up. It can diverge, obviously, but I think we will see the ISM starting to come up. Bitcoin is already priced in the ISM really quite low at about 47. So Bitcoin's diverging from these surveys as well right now because I think there's a liquidation going on in Bitcoin because liquidity is starting to come back in. Crypto's trading like shit, like somebody got hosed in October the 10th and is unwinding something. That's what it feels like to me. And, it feels like, and we'll come on to sentiment in a sec, panic lows. Okay, the dollar, big component of all of this. The dollar is what is the main part of financial conditions, which leads. The dollar is following the last Trump cycle almost perfectly. Now, the dollar's still going higher, I think, in the short term, but it should roll over and have another leg lower. Doesn't change the world if it doesn't. It just means that we have a pretty good read on when the end of the cycle is because this leads by like 9 months. So as part of our financial conditions index, but our general thesis is liquidity comes back. They start changing a few things with like SLR, stuff like that. And again, those of you on Real Vision, I can answer all the questions about this stuff tomorrow on the AMA. But generally speaking, as the liquidity comes back in, we should see the dollar have its final leg lower. Let me go on to the next bit. Technicals. So there's a few parallels. Again, remember, they're not going to be perfect. Don't expect to pay out perfectly. Think of it as contextualization and understanding, where you put it against 20 other things to try and ascertain what you think is going to happen. So Bitcoin in 2024, basically repeating. 25, repeating. Same correction. And you guys were losing your fucking shit back then as well. And guess what? It V-shaped out of it. But you don't remember that, do you? Because that would be too easy. Or whenever this correction was, July 24 to 25, same thing. Corrections are very similar. And we've got many of these charts of sort of similar style corrections. So I think we should continue that way. Bitcoin 14-day RSI as oversold as it's ever been. And basically, after this, it can fuck around a bit and then slingshots out. So expect, you can't digest a move like this instantly, but we're talking, days, a week, 2 weeks maybe, before then the market takes off. It could also just come straight out of it like it did then. We have to wait and see. Weekly Bollinger Bands, that's the contraction in volatility. We got to these super low levels. Every time we got to these levels, we've shot out of the gate. 189%, 125, 107%. It works really well. And you've all forgotten that you were feeling the same in April last year. And I was pointing this exact thing out to you. Oh, we've already just had one of these. And that was the one the prior year that finished in September, where you were losing your minds. And you were losing your mind saying, why is it not working? Everything's broken. Nothing happened. Boom. The market shot up. I mean, it went from September at wherever it was, 50,000 to over 100,000. That's Bitcoin. And then it went from 75,000 to like 120,000 after the last one. So where are we now? 28% correction. Oh, guess what? They were both 28% corrections. Will it be exactly 28%? Will it be 30%, 32%? I don't know, and I don't care. Unless you think the cycle is over, in which you have to show me other data than, well, they told me the cycle finishes after 4 years, so it's over. That's just not an argument. The other thing is, because you've all lost your shit, you're throwing poo at each other, the fear and greed index is absolutely shockingly low. We've had a whole series like 5 days or 4 days where it's been below 20, which is almost unheard of. It's like 2022 levels. So everybody is in extreme fear. You think the cycle's over, and all it's been doing is doing the same old shit. And it always does this. So these are all the corrections we've had since the start. We're at a 20%, a 20%, a 20%, a 21%, a 33%, 31%, a 28%. And then we look at it back in the previous cycle, 31%, 9%, 21%, 14%. And the previous one to that was all 35, 40%. Then 50%. And it's like, guys, this is what you pay in volatility for the returns that you get. Look at the returns.
Let us scrutinize the technical structure of the current market. Bitcoin has recently undergone a correction of roughly 28%. To the untrained eye, this appears catastrophic. However, when viewed through a cyclical lens, this is a standard deviation within a secular bull market. We observed nearly identical corrections in previous cycles, specifically 21%, 31%, and 33% drops, before the asset established new highs. Technically, the weekly Bollinger Bands are showing extreme contraction and volatility, a setup that has historically preceded explosive moves of over 100%. Furthermore, gold is currently acting as the sophisticated leading indicator. It is pricing in a future where the US dollar rolls over and financial conditions loosen. While Bitcoin is temporarily diverging due to short-term liquidation events, the correlation between global liquidity impulses and crypto price action remains statistically significant over the longer time frame.
Gold has been following this like it knows. Yeah, because gold is real-time financial conditions right now. Financial conditions, the dollar, interest rates, and commodity prices. And gold is reflecting financial conditions, which is the forward look on liquidity. I'll come on to that in a sec. A bit confusing for you all, but gold is kind of explicable right now. Here's GMI global total liquidity versus gold. Gold says it should accelerate. Global total liquidity has been it got to new highs. It's flatlined a little bit because of what the US is doing. Meanwhile, China's increasing the use of its balance sheet, and the dollar's gone up a little bit. I think it probably rolls over at some point soon. We'll come on to that in a sec. And that then may lead to the final leg higher in gold and the final leg higher in markets. But you can see gold is basically pricing global liquidity impulse all the way to the end of 2026, which would be kind of what we're expecting for the cycle. Again, don't expect perfection. Raoul said, everything moves, deviates. You need to assess the probabilities, see the data as it comes in and understand. But when I put gold versus I don't know why Julian's put everything in pink, I don't know. He's feeling flamboyant. But what we've got is that's interest payments. Gold is forward pricing it. And following up is liquidity, which lags gold by 12 months. So we've actually got the phasing of all of this, these dominoes. We talk about these dominoes all the time. And why it matters to us is because it explains 90% of crypto's moves over time. Now, again, this is the issue with the impatience and the people who don't understand this stuff is like, well, liquidity's moved. Why hasn't Bitcoin moved? It's all broken. Everything's shit. It's like, no, it doesn't work like that. There is a variability around this stuff. This is a weekly plot chart going back 11 years. Not 11 years. It actually goes back, 12 years now. And you get variability around the mean. That's how markets work. That's the 10% difference in correlation. So you expect differences, and the differences give you informational value. But what you get is this stunningly high correlation over time. And again, people don't really understand this. They're like, your charts are just correlation versus causation. They're bullshit. You're just inventing stuff. I'm like, no, and no. Okay. US government shutdown. This is where we got it wrong because it wasn't something we could know. And there's one bit we missed that we didn't really fully grok at the time. And that was the fact that once the reverse repo had been drained, which was a net stimulus, net liquidity boost, the rebuild of the Treasury General account, they build this bank account up and down. So it doesn't really matter.
The conclusion for the astute investor is one of patience and contextualization. We are likely witnessing a panic low driven by emotion rather than fundamentals. The US dollar, a primary component of financial tightness, is expected to complete a final leg lower as regulatory shifts and rate cuts materialize. This currency debasement acts as the fuel for the next upward move in scarce assets. While short-term variability is the price one pays for volatility-adjusted returns, the macroeconomic dominoes are falling into place. Interest payments are rising, the business cycle is turning, and liquidity is re-entering the system. The data indicates we are likely weeks away from a slingshot move out of this oversold territory. The cycle is not over. The data suggests it is simply reloading for the next expansion.